Small business factoring service. The solution all small business owners need. Call 888-653-0124 today or click the link in the description to learn more. Are you struggling to keep up with all the expenses that come with running your small business? Have you ever considered factoring invoices? When you run a small business, there's always going to be some sort of financial stress. Whether it's growing too fast, not being able to pay bills on time, or just plain bad luck. It's inevitable that your cash flow will suffer. If you find yourself in this situation, you may need to consider factoring invoices. We'll explain what factoring is, why it might be right for you, and how it works. How much would you pay for a service that helps businesses get cash faster? Factoring companies provide financing solutions to small businesses that typically offer lower rates than banks. They also allow businesses to receive payments up front, which means they don't have to wait months or years before receiving payment from customers. Factoring services are great for business owners who want to expand their operations without having to worry about paying back loans. Factoring services. An alternative to bank loans. If you're looking for a way to fund your small business without taking out a loan, factoring may be right for you. Factoring is a process where businesses sell their accounts receivable, AR, to a third party called a factor. The factor buys the invoices at a discount, collects payments over time, and then pays the business its full amount once the invoice is paid. Startups often use factoring because it allows them to receive funding without having to give up equity. Factors typically offer financing options to help businesses grow. They usually require collateral, such as real estate, equipment, or inventory. Factoring services are available through banks, credit unions, and online lenders. Factoring is not a loan, instead, it's a form of capitalization. When a company sells its invoices to a factor, it's giving up ownership of those invoices. This means the company no longer has access to the money owed to it. Instead, the factor owns the invoices until the invoices are collected. Factoring is like leasing, except that factors own the invoices, rather than leasing them to another entity. Factoring differs from traditional bank loans because the factor does not take possession of the assets. Factoring is also different from traditional bank loans in that the factor does not lend the money directly to the business owner. Rather, the factor purchases the invoices from the business owner. Factoring services. How they work. Factoring services are used by businesses that need cash flow right now. The company pays off its debtors, factors, upfront, usually within 24 hours. This allows the company to continue operating normally until the money arrives. Factoring companies typically require collateral, such as accounts receivable, inventory, equipment, or vehicles. But factoring companies may accept other types of collateral, such as real estate, personal property, or stock. Factoring companies are not banks. They're not subject to federal banking regulations. And they don't offer checking accounts or savings accounts. Instead, they give you cash based on the value of your invoices. If you've got bad credit, you can still apply for a factoring account. However, most factoring companies won't consider applicants with poor credit ratings. Factoring services aren't just for small businesses. Large corporations use them, too. Some factoring companies will allow you to pay back the loan over time. Others may require you to pay it back in full at once. When you factor your invoices, you're actually selling your future sales to the factoring company. So when you sell your product or service, you're also selling the right to collect payment from your customers later. You can use this method to raise capital for expansion, buy inventory, or even fund a new marketing campaign. There are many factoring companies out there. Some specialize in certain industries, such as trucking, oilfield services, manufacturing, staffing agencies, and healthcare. Other factoring companies cover multiple industries, including technology, construction, retail, transportation, logistics, and distribution. No matter what type of business you run, you can benefit from using factoring. To learn more about factoring, visit our website today. When should I use factoring services? Factoring services are used when businesses need cash fast. They're ideal for startups and small businesses because they allow them to access working capital quickly. But factoring isn't right for every business. So when should you use factoring services? If you're running out of money and need cash fast, then you definitely need factoring. But there are some situations where factoring may not be appropriate. Here are 3 reasons why factoring isn't right. 1. Your company doesn't generate enough revenue to justify factoring. 2. Your company generates too much revenue to qualify for factoring. 3. You already have a line of credit with a bank or another financial institution. In these cases, factoring isn't right. Instead, consider borrowing against your assets or selling stock. What types of factoring companies exist? Factoring companies offer businesses cash advances against future revenue streams. This means that instead of waiting months or years to receive payment, factoring companies pay out upfront. Factoring companies typically work with small businesses that need access to capital quickly. They're perfect for startups and established companies looking to expand. There are 2 types of factoring companies: asset-based and invoice-based. Asset-based factoring involves selling off assets, such as accounts receivable, inventory, equipment, and real estate. Invoice-based factoring involves providing financing based on invoices generated by clients. Factoring companies usually require collateral, such as personal guarantees, to secure funding. However, some factoring companies will finance without collateral. When selecting a factoring company, ask about the type of factoring product offered, asset-based versus invoice-based. Collateral requirements. Terms and conditions. Fees and interest rates. Payment methods. Industry experience. Once you've selected a factoring company, be sure to review its contract carefully. Some factoring contracts may include additional fees, such as monthly minimums or setup charges. Make sure these fees are clearly disclosed in writing. Also, be sure to understand what happens if your client doesn't pay back the loan. Many factoring agreements specify that the factoring company owns the invoice until your client pays back the loan. Here, the factoring company must wait 60 days before collecting any payments from your client. This can cause problems if your client goes bankrupt during that 60-day period. You'll lose money because the factoring company won't get paid back. If you decide to use invoice factoring, make sure you only factor invoices that are at least 30 days past due. Otherwise, you'll lose money when the factoring company collects on the invoices. You should also consider using a third-party service to collect on your invoices. There are many online services that allow you to upload your invoices and track their status. Some of these services even send reminders when your invoices are past due. The bottom line: choose a factoring company wisely. Look for one with a strong reputation, solid financial backing, and a proven ability to help businesses grow. How to choose a factoring company? Call 888-653-0124 today or click the link in the description to learn more.